As the world's leading exporter of petroleum, Saudi Arabia's economy has long been dependent on oil, with petroleum accounting for roughly 40% of the nation's GDP and around 75% of government revenue. Despite the kingdom's initiative to diversify its economy and pouring billions of dollars into Vision 2030, the country is still heavily reliant on oil revenue to run the economy. The country is facing growing economic challenges, including downward revisions to GDP growth by the IMF, a high break-even oil price required to balance the budget, a fiscal deficit, and difficulties in achieving its Vision 2030 goals. In this video, we will examine the major economic challenges faced by the Saudi economy in its efforts to diversify it from an oil-dependent economy to a non-oil-based economy. The kingdom's dominance in global energy markets dates back to the discovery of vast oil reserves in the 1930s, with the first commercial oil well drilled in 1938. Over the decades, Saudi Arabia became the world's largest oil exporter and a key player in the organization of the petroleum exporting countries. However, the ongoing volatility of oil prices, coupled with growing international pressure to transition to cleaner energy under the Paris Agreement of 2015, the country is taking steps to diversify its economy and reduce its reliance on fossil fuels. The increasing adoption of electric vehicles and growing investment in renewable energy sources are expected to drive a decline in global oil demand in the coming decades. According to the International Energy Agency's report, global oil demand is projected to slow significantly in the coming years. The report projects that oil demand will decline to 200,000 barrels per day between 2027 and 2028, and the demand will further reduce to 100,000 barrels per day between 2028 and 2029. Moreover, the diminished role of OPEC countries in boosting oil prices is further exacerbating Saudi Arabia's oil-related challenges. Historically, OPEC's production cuts have played a crucial role in stabilizing oil prices. However, the rise of U.S. shale oil production and other non-OPEC producers such as Canada, Brazil, and Norway has reduced OPEC's market share and influence. OPEC's share of global oil production declined from 42% in 2012 to 36% in 2023. This shift has limited Saudi Arabia's ability to unilaterally influence oil prices, making it increasingly challenging for the kingdom to achieve its desired oil price of around $90 to $100 per barrel. According to the IMF, the break-even fiscal oil price for Saudi Arabia stands at around $100 per barrel in 2024, up from $67 in 2010. This increase is largely driven by the country's rising spending commitments. The kingdom's ambitious megaprojects, such as NEOM, which is estimated to cost $1.5 trillion, coupled with rising domestic fuel consumption, are driving up its break-even price. In response to rising oil-related challenges, Saudi Arabia has made substantial progress in diversifying its economy. The non-oil sector's contribution to Saudi Arabia's GDP has continued to grow, reaching a significant milestone of 50% in 2023, according to the Saudi General Authority for Statistics. One of the largest programs launched by Saudi government to expand its non-oil sector is the Vision 2030 initiative. This project was launched by Crown Prince Mohammed bin Salman in 2016. The initiative seeks to develop new industries, foster entrepreneurship, and create jobs in sectors such as tourism, technology, and renewable energy. A key component of this plan is the development of NEOM, a $1.5 trillion futuristic smart city stretching across 10,000 square miles on the Red Sea. The project envisions a substantial expansion of Saudi Arabia's tourism sector, with iconic projects like the Red Sea resorts and the development of leisure and entertainment infrastructure designed to draw millions of international tourists. The Public Investment Fund has committed billions of dollars to develop hotels, resorts, and cultural attractions, aiming to attract a staggering 2 million visitors per year by 2030. However, the path to achieving these ambitious goals is fraught with challenges. As a relatively new player in the global tourism market, Saudi Arabia's ability to attract international tourists is challenging. Saudi Arabia only opened its doors to foreign tourists with the introduction of tourist visas in 2019. The country will need to contend with intense competition from established tourist destinations in the Middle East, including the United Arab Emirates, Egypt, and Turkey, which have well-developed tourism industries and strong global brands. Moreover, Saudi 2025 budget anticipates $27 billion fiscal deficit as gigaproject spending continues. The country has increased government spending by 38% in its 2025 budget, primarily due to the continuation of massive spending on projects aligned with Vision 2030. According to Saudi authorities, the national budget is anticipated to remain in deficit for the next several years, as the government continues to invest heavily in the implementation of its ambitious Vision 2030 development strategy. The Public Investment Fund, which is responsible to raise funds for the Vision 2030 of Saudi Arabia, is facing challenges due to declining oil revenues. The fund, which is among the largest sovereign wealth funds in the world, aims to grow its assets under management to $1 trillion by 2025, but its reliance on oil revenues and limited diversification of its funding sources pose significant challenges to achieving Vision 2030 goals. Saudi Arabia is also facing numerous challenges to attract adequate foreign investment to meet the goals of Vision 2030. The nation aims to attract $100 billion in foreign investment by 2030. However, halfway through its Vision 2030 plan, the country is facing challenges in meeting this goal. Despite efforts to improve the business environment, foreign investment in Saudi Arabia remains low, totaling only $5.2 billion in the second quarter 2024. Many analysts outside the kingdom, as well as individuals involved in NEOM projects, have expressed widespread skepticism regarding the viability and practicality of Saudi Arabia's ambitious megaprojects. Reports indicates that some projects have undergone significant scale-back, such as the Line project, which has seen its proposed length reduced from 106 miles to 1.5 miles and its targeted population decreased from 1.5 million by 2030 to under 300,000. The kingdom has also implemented various reforms as part of the diversifying efforts which are negatively affecting the business's environment. The reduction of subsidies, a critical part of the government's reform agenda, has increased operating costs for businesses. Similarly, the introduction of new taxes, such as the value-added tax, which rose from 5% to 15% in 2020, has added financial burdens for companies and consumers alike. Rising labor costs due to policies encouraging the employment of Saudis instead of lower-cost migrant workers have further eroded the country's traditional competitive advantages. While these measures are aimed at diversifying the economy and stabilizing public finances, they have made the business environment more expensive and challenging, potentially deterring some foreign investors. In short, as the global economy undergoes a significant shift towards renewable energy sources, Saudi Arabia finds itself at a crossroads. With global oil demand projected to decline in the coming decades due to shifts toward renewable energy and climate action, the kingdom is diversifying its economy to reduce its reliance on oil revenues. However, the path forward is fraught with challenges, including creating jobs for a young population, handling its rising fiscal deficit, promoting tourism amid stiff competition, and addressing investor concerns about governance. The success of this transformation will determine whether Saudi Arabia can sustain its prosperity and secure a resilient, diversified economy in a post-oil world.